We need to get ready for something big. The real smart big money is, like I said, we've had a couple of 9-figure sales recently, and you can see that insiders are selling. You can see that we are in historic bubbles that have never been seen before. But what I am doing and have done to get prepared, most of my largest position is in physical silver. The truth lies somewhere between this green line and that blue line. But get ready for some real fireworks.
MikeMaloney, founder of goldsilver.com, has issued a clear warning that something significant is on the horizon for the global economy. According to Maloney, the smartest and wealthiest investors are already making significant moves. Recent 9-figure asset sales and insider activity suggest we are amid financial bubbles unlike before. In light of this, Maloney has shifted his portfolio heavily towards physical silver, viewing it as a critical hedge against the coming volatility. Silver prices recently soared during the North American trading session, driven by a drop in US Treasury bond yields. Even as traders adjusted expectations around the Federal Reserve's potential policy easing, precious metals, particularly silver, continued to climb. The silver dollar trade was $32.33, a 2.26% increase. This surge in silver and gold prices reflects economic uncertainties, geopolitical tensions, and technical breakouts in the market. While some forecasts for silver prices may seem ambitious, historical volatility in the precious metals market suggests that significant price moves are always possible. However, investors should approach these price projections with caution. The precious metals market is notorious for its unpredictable swings, and historical performance does not guarantee future results. As Maloney notes, the real value of silver likely falls somewhere between the estimates provided by Shadow Stats and the official Consumer Price Index. Yet, he also stresses that we are on the brink of significant price movements for silver, advising investors to prepare for what he describes as upcoming fireworks. Market analysts are also closely monitoring silver's price chart, with many suggesting that emerging technical patterns could signal further upside potential. Historical precedent supports the possibility of dramatic gains. Between 2001 and 2011, silver experienced a meteoric rise, climbing from under $5 per ounce to $50 per ounce, a staggering tenfold increase. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
And here is why. If this is the gold line down here is the nominal silver price, going all the way back to 1970. The dark blue line is the official CPI. This greenish line, or turquoise, or whatever it is the Shadow Stats price. But Shadow Stats is a United States CPI adjusted. He's just using the old numbers, the old way they used to calculate the CPI. It comes up with $1,800 silver. And I need to show you something. There's a chapter in my book on silver. What I came up with, I'm trying to find the page here, the silver lining is the chapter, and I analyze it and compare it to a bunch of other things in the U.S. economy. Consumer Price Index today, when I wrote the book back so this was October of 2022, the CPI gave me, if I adjusted it for the $50 peak in 1980, it was $200 silver. Median price single family home, if you adjust it by the same percentage that real estate went up during that period of time, $468 silver. The Wilshire 5000 stock index, $2,178 silver. The 10-year Treasury bond, $1,059 silver. The US GDP, $468 silver. Currency in circulation, $971 silver. M2, $781 silver. And MZM was $1,250 silver, but they discontinued MZM. And so you had an average of $921 silver per ounce using the same type of growth. That's if silver goes into the same type of bubble that it did back in January 1980 compared to all of the other things in the U.S. economy. And so the truth lies somewhere between this green line and that blue line. But get ready for some real fireworks. They're coming up pretty soon.
In 2024, Nvidia's valuation has soared to unprecedented levels, making up over 11.7% of the US GDP, starkly contrasting to Cisco's 5.5% valuation at the peak of the 2000 dot-com bubble. This makes Nvidia's current market cap more than 200% higher than Cisco's during its height, which MikeMaloney refers to as evidence of a super-hyper bubble. Nvidia's stock surge has been fueled by optimism surrounding AI chip demand, with a positive outlook from Taiwan semiconductor manufacturing company further boosting sentiment. On Thursday, U.S. tech stocks climbed higher, with Nvidia hitting an all-time high, driven by robust retail sales data, reinforcing confidence in the broader U.S. economy. At the time of writing, Nvidia's share price stands at $139.76, marking an impressive 190.14% rally throughout 2024, with a significant 75.77% of that gain occurring in just the last 6 months. Nvidia is now in close contention to become the first company to reach a $4 trillion market capitalization. However, despite this surge, growing concerns about a potential bubble exist. A chart shared by the Kobeisi letter, created by Kevin C. Smith, CFA, draws a striking parallel between Nvidia today and Cisco during the 2000 dot-com bubble. At its peak, Cisco's market cap accounted for 5.5% of the US GDP. Still, Nvidia now exceeds that, representing 11.7% of the country's GDP, a more than twofold increase relative to Cisco's historical peak. Maloney warns that the fallout could be even more catastrophic when this bubble bursts than the 2008 financial crisis. He emphasizes that Nvidia's extraordinary market valuation, relative to the U.S. economy, represents a bubble of unsustainable proportions, and its collapse could lead to widespread market disruption. With echoes of the dot-com bubble looming, Maloney cautions investors to brace for a significant correction. Let's get back to the interview.
This is the S&P 500, and this is corporate insider buying. So it's the amount of corporate insider buying, and what you notice is that they buy a lot after dips and whenever the Federal Reserve created a whole bunch of currency. And then they're not buying, and sometimes they are selling during market peaks. So when the market is peaking is when they are selling. They are selling now, but the market hasn't quite peaked yet. But this is something that is saying it will, and it's going to be soon. This is the spread between U.S. BBB corporate bond yields and the 3-month Treasury bill. And you see that 1929 and then 1932. So this is the peak of the good times just before a crash, and that is the bottom, the trough in the bad times. Here's 2007, peak of the real estate bubble, 2008 global financial crisis. Look at where we are today compared to 2007. This is from Mr. Mike Investing. Nvidia in 2024 versus Cisco in the year 2000. Now, I was looking at this and then I realized, oh my gosh, this is as a percentage of GDP. At the peak of the dot-com bubble, Cisco was worth 5.5% of the US GDP, and today, Nvidia is worth over 11.7%, almost 12%, which is 200% higher. When this bubble pops, and it will lead to a collapse bigger than 2008. It is only a matter of time. One company worth almost 12% of the entire economic output of the United States. This is a super hyper bubble. This, somebody posted here, this is the Great Martis. The Buffett indicator just blew past 200. Ladies and gentlemen, we are now in uncharted waters. God help us all. Well, at the Limitless Expo in Dallas, I presented the Buffett indicator. I went to update this chart just now because I like to look at it historically. We've been in uncharted waters ever since we passed about 150% of GDP. So I went to update it, went to the Fed's website where, this is where all of my charts come from, all of the data, and I put in Wilshire, no results. This is where I always found the Wilshire 5000 total market cap index, and I would divide that by GDP and make my own Buffett indicator, and they just deleted it. I'm going to show you discontinued data sets later because the Fed has been discontinuing a lot of them. But if somebody is doing something that they don't like that really makes things look bad, like the Buffett indicator, they just delete it now. They don't even tell you they're discontinuing it.
As market volatility intensifies, silver and high-flying tech stocks like Nvidia present contrasting opportunities and risks. While precious metals continue rising amidst economic uncertainty, concerns about an overinflated tech sector loom. The rapid ascent of Nvidia's valuation is a stark reminder of the potential for market bubbles, leaving investors to weigh their strategies carefully. What do you think? Are we heading toward a massive correction, or will these trends continue to surprise investors? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.